Hello traders, Nick Shaheen here looking at options in general. I get the question, what do you do? And when I answer I do options, the glassy-eyed look and they nod, but it's really a foreign concept to a lot of people, understandably so. So basically 5 minutes, I'm going to try to stick to it to explain quickly in plain simple English the idea of it. And then, the details will be future questions. Before I forget, at the end, there'll be subscribe to this channel. It's free on YouTube. Hit it. And if you want to learn more, also I'll put in the description what we can do about that. All right, so share this video if you want. All right, so the options, every stock out there, almost every big stock out there has a series of options available. In this case, we're looking at Facebook. The stock is $212 as of today, so February 7th, and then it has several contracts available right now. They expire weekly, but they all started with just having monthlies, those white ones. Every month there used to be one contract that expired. So basically options are a set of contracts at different price levels. The idea is old. Businesses that wanted to hedge, they use futures contracts, and this is an extension of it in my opinion. So if you dealt with a lot of cheese, you wanted to lock in your price of cheese, there was a contract done for that. And yes, you may lose a little bit at times, you make out a little bit at times, but at least you won't have the disasters where, like, if all cheese goes bad, suddenly you're paying $1 billion for a piece of cheese, and your restaurant will go belly up, for example. So that's where the concept came from. So in this case, people wanted to protect their investment in stocks, so they created the options. And now they become a trading vehicle. And I'll try to describe it. There are two kinds of options. Again, they're contracts, so they have time. They expire. We have them expiring every week, like this set expired today. There's one in 2 weeks, in 3, 4, 5, and then you get the March contract, 42 days on that. You get the April. I can go out to next year's January. I can go out to 2 years out to January. These are called leaps when they're so far out, leap in time. All right, so we have put options and call options. So when we're looking at the table, you see the price goes up. So where the color changes is about where the price is. 212.5 is about where the price is. On the put side, I'll start there because it's an easier concept. If I own shares of Facebook and I was worried about the virus, for example, for next week, what's the market going to do? Oh my gosh, is it going to drop 20%? I can buy protection. I can go buy insurance, just like for a car, just like for a house. If I owned 100 shares of this, it's a nice sum of money. So why not spend a few bucks protecting that? And the good thing is I can determine my time. If I only need it for a week, then I'll just look at this contract and I don't have to spend a lot of money. So in this case, I can protect for 18 cents per contract. I buy one, I protect 100 shares. And I'll stop my losses below that. So how does that work? When I buy this contract, by the way, nothing here is a action to buy. I'm just explaining the concept. If I buy this contract, I'm saying, hey, I'm okay taking losses down to 197.50, but then below that, I want somebody to buy it off my hands. Somebody will do the homework and decide that there's no way it's going down below 197.50. Hey, they'll call me. I'll take that bet. Don't worry. You can go sleep knowing that if it falls to zero, I'll buy them from you for 197.50. And for that, I pay them a premium of 18 cents for 100 shares. So sounds like a good deal, right? But it gets expensive if people do that all the time. So I'll show you why. If I go out to March and I say I want protection for 42 days, suddenly we're talking $2.60 at the $200 level per contract. So if I buy one contract, you multiply by 100 because each contract represents 100 shares. So it's 266 bucks for 42 days. It's not bad if I own, if I want to really stop the loss right here. But I can't do that all the time. It's just not right. So it's not smart, I should say. But that's the concept of it. That's how the puts work. I'm buying insurance. If you study options, any book you pick up, the first paragraph, I guarantee you, will say something like this. Most options expire worthless. First of all, I'd like to see the data on that, how many of these are spreads and all of that. But anyway, let's assume that this is correct. Therefore, I don't want to be in the habit of buying a ton of them. So limit my buying, which opens an opportunity of selling. So if you're good and you do your homework and you know where something, if I wanted to buy the shares at 185 anyway, why don't I sell the options to somebody and say, hey, who wants to sell their their shares at 185? I'm a buyer. They'll pay me to wait for the stock to fall and me buying it. So that's the concept of selling, better than the buying. But anyway, back to the definition. So the puts is somebody wants to buy insurance, and it's a contract between buyer and seller. I don't have to pick up the phone. I simply click buy, and I'll offer the price I want to pay. What's the price? Usually it's the mark between bid and ask. So now what's the call option for? The call option is for the opposite. When I want to lock my price, but I don't want to buy the shares. So I don't want to spend $200, $215, $212 buying 100 shares of Facebook right now. I think it's going to go up, but I'm afraid of the next few months. I would like to lock my price at that level or any level. So I will say, okay, for the next 42 days, I'd like to lock my price at $225. I don't want to miss out. So, but I don't want to spend $200 per share. So I'll pay $2.50 for the right to buy them at that price if they go to $1 million. So like insurance, this is somebody who's saying, I promise you I will sell you my shares at $225 even if they go up to $1 million. I'll say, okay, and I'll take that piece of paper basically, guaranteeing me the price of $225. So I will break even $2.50 higher because I paid that much to get that right. So I'm hoping it goes to $2.30 or higher. Then I'm starting to make money. So those are the concepts of options. They are contracts. They have time limits and levels. So on the put side, put options, call options. On the put side is for protection. Think protection. Stock falls, I want out at 200. I don't want any losses beyond 200. I pay a premium for that. Let's say I bought the shares at 150, and I want protection through September. So then I'll go out to September and go down to 150. It's off the screen. And I'll pay $1.50 per contract. Not a bad deal, you know. If I can sleep well, knowing that my bottom line is protected at 150. That's one way of doing it. So why would anybody be excited about the call options? I'm going to use the lunatic stock of the week, Tesla. First of all, these options are so inflated, it's not even funny. And this is like a half of what they were earlier this week. The implied volatility here is 100% more. So that's how nervous markets are. And when markets become nervous, these premiums that I have to pay for the options go ballistic. Look at these premiums. $40 to buy a put here. Equally as high to buy a call. This is just with no event. There is no event. This is how nervous people are over the stock. So let's say I think Tesla is going to $2,000 a share. I don't, but let's say I did. There are people out there that think it's going to 7,000. Let's say these people don't want to spend $740 per share right now. So what they do is they say, you know what? Let me spend a fraction of this and lock my price. I wouldn't do it for February 14th because of the implied volatility. I told you they're 100 and some percent nervous. They're a little bit lower out in time, but that's still astronomical. I bet you Facebook or Apple would be in the 20s. So this 60 is too high. So I'm paying too much. When this craze blows over the Tesla thing, even if price stays the same, these prices are going to get slashed. So I'm going to lose money just by sheer fact that people are going to calm down a little bit. Anyway, so this will $143 guarantees me to lock the price at $755. So if it goes to $1 million, I'm in at $755 plus $140 because that's how much I'm paying for that right. So you get the point. Instead of spending $750, I'm spending $140 to be in at $755. plus, the break-even point. So it does make sense. Now, from a trading perspective, that's a completely different story. These things, if a stock is up 3, 5, 10%, you think, sweet, I just made 10% overnight. If you do it via options, the percentage move would be hundreds of times bigger. So it all depends on the time, expiration time. If I picked the same, like Tesla, there were people that bought contracts for 5 cents and then they sold them for over $1. So yeah, the stock moved 20%, 40%. How much is $1.50 over 5 cents? Way bigger bang for the buck. So clearly those home runs are not like that. But if a stock moves X percent, the move in the options guaranteed is 10 times bigger. So bigger bang for the buck. So it makes them exciting. But unfortunately, it also makes them dangerous from that sense. They're safer than stocks, in my opinion, if you do them right. But they can siphon money quicker because of that oomph that there is in the bang for the buck works against you. If I buy shares and they fall 2-3%, not a big deal. But if I buy call options and the stock falls 2 or 3%, the call fall a lot faster, just like they gain a lot faster. So if I guess incorrectly, I lose faster. But if I guess correctly the direction, I win a lot faster. That's why people start jumping in and buying left and right, and they end up with empty accounts because no homework, no nothing. They just jump in and buy it. Now, it is so important to do the homework and know when to go. For example, I'm looking at Pinterest here. Great reaction to the earnings. Is it a good time to get in? Not in my eye, because I'm not judging the company. I'm looking at the chart, and it looks like it's headed into, it just reached a prior accident scene. So anybody stuck here is going to sell. So that just creates some selling action just from that fact. So maybe I'll wait a few ticks before I start buying call options. So if I'm chasing options, it's expensive if I make a mistake. All right, that's enough. I think I broke my 5-minute rule. Dang it, it's 12 minutes. Sorry about that, but I think it was a good, plain, simple English. Okay, so there's a ton of jargon. Theta this, Vega that, Delta this. I can explain all of it in plain, simple English. Trust me, this is just fancy terms to scare the people out. It's plain logic. Nick signing out.